Something is happening right now that most investors have completely wrong. Bitcoin is struggling. AI stocks are on fire. Private tech companies are pulling in billions every single week. And for the first time in years, quietly, behind closed doors, serious investors are starting to ask a question they never thought they'd ask. What if Bitcoin is no longer the most exciting bet on the future? Think about what that question even means. 3 years ago, you couldn't walk into a room full of money managers without the conversation turning to Bitcoin within 5 minutes. It was going to replace gold, replace the dollar, replace the banks, replace the entire machinery of global finance. Now, those same people are talking about AI agents, data center buildouts, humanoid robots, and trillion-dollar software valuations. The spotlight has shifted dramatically. And before you dismiss that as just another market cycle, before you say Bitcoin always comes back or AI is just hype, I want you to stay with me until around the 14-minute mark. Because what I'm going to show you in this video isn't what most people think this story is about. This isn't about Bitcoin dying. This isn't about AI winning. This is about something much deeper. A structural shift in how capital, technology, and money itself are about to move together. And by the end of this, your question won't be, which one do I pick? Your question is going to be, why didn't I see this sooner? Quick note, nothing in this video is financial advice. I'm not your financial advisor. This is for education and informed conversation. Always do your own research. If you're new here, welcome to the Wealth Continuum, where we track the intersections of money, technology, and the future. Subscribe now if you want to stay ahead of what's coming, because we cover this kind of shift before it becomes obvious. One of the costliest mistakes any investor can make is assuming that when money moves, it's because something broke. Sometimes money moves because something better, or at least something that feels better, appeared on the horizon. And that is exactly what is happening right now. Here's how I want you to think about this. Imagine you're running a multi-billion-dollar fund. Every single morning, you wake up with one job, find the next trillion-dollar trend before everyone else does. You are paid incredibly well to see around corners. Where does your attention go in June of 2026? Does it go to an asset class that has been around for nearly 2 decades, one that the whole world already knows about, with mature narratives, established arguments, and price history stretching back to 2009? Or does it go to a technology that could literally reshape every industry on Earth? Healthcare, logistics, finance, manufacturing, defense, within the next decade? That is the pull Bitcoin is fighting against right now. Not because Bitcoin is broken, not because the network stopped working, not because institutions abandoned it, but because there is another story in the room, and that story is louder. Venture capital is flooding into AI at a pace that is genuinely historic. Global AI investment in 2025 alone exceeded $500 billion across private and public markets. The build-out of AI infrastructure, data centers, chips, energy systems, is consuming capital at a rate we haven't seen since the early internet era. And that capital has to come from somewhere. Some of it is new money. Pension funds, sovereign wealth funds, endowments, all opening allocation buckets for AI-related assets that simply didn't exist 2 years ago. But some of it is repositioning. And repositioning means things that were popular before become less popular now. Now here's what nobody is saying out loud. Money isn't leaving Bitcoin because Bitcoin failed its investors. Money is leaving Bitcoin because investors believe, whether correctly or incorrectly, that AI is going to produce faster, larger returns in the near term. That is a rotation, not a funeral. And the distinction matters enormously. Comment below right now, are you currently more focused on AI investments, Bitcoin, or are you holding both? I genuinely want to know where this audience is positioned. But here's where things start to break down. Most investors treating this as an AI versus Bitcoin debate are making a fundamental error in how they're framing the question. Macro investor Jordi Visser, someone who has navigated these transitions for decades, believes this framing is not just incorrect. He believes it's going to be expensive for the people who hold on to it, because at their core, both Bitcoin and AI require investors to make the exact same kind of bet, a bet on the future. But think about that. Nobody can tell you with certainty what the AI economy looks like in 2035. Nobody can guarantee which companies dominate. Nobody knows how governments regulate it, how it reshapes labor markets, or what second and third order effects it creates across society. And yet, investors are happily assigning enormous, sometimes extraordinary, valuations based on those uncertain possibilities. They are buying a vision, a future that doesn't fully exist yet. Now tell me, how is that any different from what Bitcoin investors have been doing since 2009? Bitcoin investors are also buying a vision, a future where digital scarcity matters, where fiat money continues losing purchasing power, where decentralized networks become a critical layer of global financial infrastructure. Both are bets on a future. But one is called visionary, and the other gets called speculative, that inconsistency is important, and it's going to become very important to understand over the next few years. Hit like if this is starting to make sense, because this framing is exactly what most mainstream coverage gets completely wrong. Jordi Visser raised a comparison recently that I think is one of the clearest and most underappreciated arguments in this entire debate. Let's talk about SpaceX for a moment. SpaceX is a private company, last valued in the range of $350 billion in early 2026 secondary market transactions. Investors are willing to assign that kind of number to a business whose most ambitious goals remain years, possibly decades away. Colonizing Mars, making humanity a multiplanetary species, building space-based internet infrastructure that transforms connectivity globally, redefining point-to-point transportation on Earth. These are extraordinary ambitions, but let me also be direct about something. They are deeply uncertain ambitions. There is no guaranteed roadmap to Mars. There is no proof that the economics of interplanetary transport work at scale. There's no guarantee that governments won't introduce regulatory friction at critical moments. There's no model that definitively shows how this business generates the returns that justify those valuations in a reasonable time frame. And yet, investors remain excited, enthusiastic even. Why? Because they believe in the long-term vision, because they're willing to look past near-term uncertainty to see a possible future that justifies the price. Now, I want you to hold that in your mind, and then ask yourself this question: how is that fundamentally different from Bitcoin? Because Bitcoin investors are doing the exact same thing. They're looking past near-term price volatility, regulatory noise, and shifting market narratives, and betting on a long-term vision. A vision where digital scarcity becomes foundational infrastructure for a more digital world. A vision where the ongoing debasement of fiat currencies, something we've watched happen in real time across every major economy, eventually forces a reckoning. A vision where trust, over time, migrates from centralized institutions to decentralized protocols. Both are long-duration bets, both require patience, both require comfort with uncertainty, but investors treat them very differently. And Jordi's argument is that this inconsistency reveals something important, not about the assets themselves, but about human psychology. We criticize Bitcoin not because its future is uncertain. We criticize Bitcoin because its uncertainty is visible and familiar. We've seen the price charts. We remember the crashes. The narrative baggage is heavy. Meanwhile, we embrace uncertainty in new, exciting-sounding investments because the unfamiliarity makes the uncertainty feel like potential instead of risk. That is a cognitive bias, a very expensive one. Now here's where Jordi's argument goes somewhere most people aren't expecting. Because the future he sees isn't a future where AI and Bitcoin compete. It's a future where AI makes Bitcoin dramatically more valuable. And this is where I want you to pay very close attention. Most investors are asking, will AI replace Bitcoin? That is the wrong question. Here is the right question. What happens when AI starts participating in the economy? Not as a tool, but as an actor. Let me unpack that. Think about how economic activity works today. Human beings earn income. Human beings make purchasing decisions. Human beings negotiate contracts. Human beings manage supply chains. Human beings send payments, settle invoices, authorize transactions. Every dollar that flows through the economy is ultimately touched at some point by a human decision. That model is changing, not hypothetically, not someday. It is changing right now in 2026 in ways that are already measurable. AI agents are beginning to perform tasks that humans use to perform exclusively. Software is starting to negotiate, execute, and manage complex workflows without human intervention at every step. Autonomous systems are handling logistics decisions in real time that previously required entire departments. And as that process accelerates, as AI agents become more capable, more interconnected, and more embedded in the actual mechanics of commerce, a question emerges that almost nobody is asking yet. What monetary system do those agents use? Think about this seriously for a moment. If you have millions, eventually hundreds of millions, of AI agents conducting transactions on behalf of businesses, governments, and individuals across the globe, 24 hours a day, 7 days a week, they need a payment and settlement layer. Will they use SWIFT, a system designed in the 1970s, built around banking hours and correspondent relationships? Will they operate within the borders of individual national payment systems, each with their own rules, currencies, and settlement windows? Or will they gravitate towards something that was designed from the ground up to be digital, borderless, permissionless, and always on? This is why Jordi doesn't see AI as a threat to Bitcoin. He sees AI as a catalyst for Bitcoin. The more digital the economy becomes, the more participants in that economy need a monetary layer that is natively digital. And Bitcoin, with its fixed supply, global accessibility, and 2-decade track record of uninterrupted operation, is the largest such network ever created. Now here's the part nobody is paying attention to. This isn't just speculation about a distant future. The infrastructure build-out for AI native commerce is happening today. Autonomous agent frameworks, AI to AI payment rails, programmable settlement systems, these are active areas of development right now. The question isn't whether AI agents will need to transact. The question is, which monetary network will emerge as the default layer for that transactional activity? And Bitcoin is already there. Now, I want to take a slight turn here because Jordi makes an argument that is genuinely unsettling if you think it through. And it has nothing to do with Bitcoin. It has to do with the companies most investors consider the safest bets in their portfolios. The large cap tech companies, the trillion-dollar names, the ones sitting at the core of every major index. We're talking about the kinds of companies that dominate retirement accounts, pension funds, and passive ETF portfolios around the world. Most investors treat these companies as permanent winners, built-in advantages, network effects, brand recognition, regulatory capture, infrastructure so deep and entrenched that no competitor could displace them. Jordi's argument is that AI disrupts that assumption in ways that markets are not fully pricing in. Here's why. For decades, competitive moats were built on scale. You needed enormous distribution networks, physical infrastructure, thousands of employees, massive capital expenditure just to reach the market. That scale created barriers that protected incumbents. AI doesn't care about those barriers. A small team with the right AI stack can now compete with departments, divisions, and sometimes entire companies. The cost of building sophisticated software products has collapsed. The cost of automating complex processes is collapsing. And when scale-based advantages erode, the companies that were protected by those advantages become vulnerable. Not all of them, and not overnight. But the process of repricing those risks could be one of the most significant capital reallocation events of the next decade. So here's the thought experiment Jordi wants you to sit with. In a world where everything becomes easier to replicate, where software can do what armies of professionals once did, what becomes more valuable? The things that can't be replicated: scarcity, verifiable, unforgeable, mathematically enforced scarcity. That's the only thing AI cannot manufacture. And that is exactly what Bitcoin provides. While AI generates abundance, more content, more code, more products, more services, Bitcoin remains the one asset in the digital world where the supply is completely and permanently fixed. 21 million coins. That number doesn't change whether AI becomes more powerful or less powerful, whether 1,000 companies thrive or fail, whether governments cooperate or compete. The scarcity is structural, not a policy decision that can be reversed. All right, let's come back to the question that's actually on most people's minds right now. If the long-term story for Bitcoin is intact, if AI is eventually a tailwind rather than a headwind, then why is the price still struggling? Why isn't the market pricing in this future? This is where market psychology becomes absolutely critical to understand. And the answer is something that separates experienced investors from everyone else. Markets don't price in long-term futures in a straight line. Even the most powerful long-term trends go through periods of exhaustion, disillusionment, and sideways drift. In fact, those periods aren't bugs in the system. They are features. They're what shakes out impatient capital, what creates the conditions for the next phase of accumulation. Look at what happened to Bitcoin in the past 18 months. Spot ETFs finally launched in the United States, a milestone that Bitcoin investors had been waiting years for. Institutional custodial infrastructure matured significantly. Regulatory frameworks began developing across multiple jurisdictions. Political sentiment shifted in ways that felt unprecedented just a few years prior. These were enormous catalysts, events that the market had been anticipating, discussing, and pricing in hopes for over many years. And here's the thing about anticipated catalysts. By the time they arrive, they've often already been absorbed into price. The excitement was front-loaded. The institutional buyers who were waiting for clarity, many of them have already positioned. The marginal buyer who needed an ETF to gain access, they've had access for over a year now. So when the catalysts land and the price doesn't immediately roar higher, the narrative shifts. Headlines declare that Bitcoin is failing, that the bull case was wrong, that capital has found better homes, and that narrative itself drives more selling, which creates an environment that looks, on the surface, like collapse. But underneath, the fundamentals remain intact. The network continues producing blocks every 10 minutes, exactly as designed. Hash rate, the measure of computational power securing the network, has remained near historical highs throughout this period, meaning miners are still investing in the long-term integrity of the system. Long-term holders, the wallets that have held Bitcoin for more than a year without moving it, represent a historically large share of the circulating supply. These are not people who bought in a panic and are waiting to sell. These are people who have made a deliberate, informed decision to hold through exactly this kind of environment. That is not what collapse looks like. That is what transition looks like. Now, here's where things get interesting. and where I want to be careful to be precise because precision matters. I'm not here to give you a price target. I'm not going to tell you when the next rally starts. But I do want to walk you through the signals that historically appear near major inflection points in Bitcoin cycles, because several of them are showing up right now. First, the 200-week moving average. This is one of the most closely watched long-term technical levels in Bitcoin's history. It represents roughly 4 years of price data, smoothed across time. And historically, Bitcoin has spent very little time below this level. Previous encounters with the 200-week moving average have often occurred near cycle lows. Not always, and not with perfect precision, but with enough consistency that long-term investors pay close attention when price approaches this zone. Second, short-term holder behavior. The on-chain data tells a very specific story right now. Short-term holders, wallets that have held Bitcoin for fewer than 155 days, are showing significant capitulation behavior. They are selling at a loss. They are exiting. Historically, this pattern, widespread short-term holder capitulation, has been a characteristic of market bottoms, not of mid-cycle corrections. It appears when the people who bought during the excitement phase finally run out of patience and give up. Their loss is absorbed by someone else, and that someone else is historically the long-term holder. The person who has seen this pattern before and is quietly, steadily accumulating while the headlines say to panic. Third, funding rates and sentiment. Futures funding rates, the cost of maintaining leveraged long positions, have been flat to negative for extended periods. That tells you the speculative crowd is not bullish right now. There is no excess froth, no overleveraged longs waiting to be liquidated. This is what the bottom of a sentiment cycle looks like. Not guaranteed, never guaranteed. But the setup, the structural conditions that have historically preceded significant recoveries, are present in ways that experienced investors are noting. The question is never, is this the bottom? The better question is the risk-reward favorable enough to act on the thesis? And that is a question only you can answer based on your own time horizon, your own risk tolerance, and your own understanding of what's at stake. What would you do if this actually plays out the way the data suggests? Are you positioned, or are you still watching? Leave that in the comments, because the conversation down there is genuinely worth having. Retail investors focus on headlines. Professional investors focus on fundamentals. They ask a simple question: has the original thesis changed? For Bitcoin, the answer appears to be no. The supply is still fixed. The network still works. Institutional infrastructure continues growing. Adoption continues expanding. And the long-term case remains intact. So instead of chasing short-term moves, many sophisticated investors are focusing on the bigger picture. The global economy is becoming more digital. That trend is accelerating. At the same time, AI is becoming more integrated into business and commerce. As AI agents become economic participants, they will need financial infrastructure. They need systems that are digital, global, always online. Bitcoin already possesses those characteristics, and that's why some investors believe we're still early. Most people are focused on AI itself. Very few are asking what financial system AI might eventually rely on. That could be where the real opportunity exists. So is AI replacing Bitcoin? Probably not. In fact, they may be part of the same story. AI creates intelligence. Bitcoin creates scarcity. AI increases productivity. Bitcoin provides a fixed monetary asset. AI changes how value is created. Bitcoin may help define how value is stored and transferred. The biggest investment opportunities often appear before the crowd understands the connection. And today, most investors are looking at AI and Bitcoin as competitors. But what if they're actually partners? That's the question worth thinking about. If AI becomes the backbone of the digital economy, what role do you think Bitcoin will play? Let me know in the comments. And if you enjoyed this breakdown, subscribe to the Wealth Continuum for more insights on money, technology, and the future.